Good afternoon and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. A few reminders: anyone who is registered for today's program will be receiving a copy by early next week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Today, we welcome back our good friend, Cox Senior Economist, Charlie Chesbrough. Charlie, I know you have a lot to cover today, so I'm just going to let you take it away.
All right. Well, thank you so much. And thank you to everybody for joining us today. There certainly is a lot going on out there, and I'm going to try to cover it as much as possible for the automotive industry. But I think the key takeaway is there's just still a tremendous amount of uncertainty. And so I've titled my presentation today, Curves on the Road Ahead. And unfortunately, those curves aren't going away anytime soon. And we're going to cover a couple of different topics today. We usually cover these areas almost every time I talk to you guys. But we're going to start by giving the economic and automotive outlook for the industry out there. And concerns are rising. And I'll take you through what folks are worried about out there. But there is growing concern that we may be on the cusp of a recession. We're starting to see some weakening in the jobs numbers, and that's got a lot of folks concerned about that. But not automotive buyers, at least not yet. The other thing I wanted to talk about is these tariffs. We had expectations that they were going to have a massive impact on the vehicle market, and we still think that they will, but it just hasn't happened yet. And I'll show you where we're at in terms of that data. Then I want to talk about what we are seeing out there for the vehicle markets, and that is that inflation is heating up. We're seeing prices starting to rise in both the new and the used market. And as the impact of these tariffs starts to grow here in the coming months, that inflationary pressure is likely to get even hotter. And then the last thing I wanted to just talk about is what's next, which is the EV and PHEV, or the plug-ins Armageddon, which is just weeks away. And what I mean by that is on September 30th, the $7,500 federal subsidy for electric vehicles is going to expire. And we're seeing tremendous amount of activity out there of consumers going out and buying these vehicles over the last couple of months. But we think that just means it's going to be hitting a brick wall once we get past that and those tax credits actually expire. And we're going to see electric vehicle sales fall dramatically. So let's just start by what the big news out there, which is inflation. And this is a chart that's showing the consumer price index, the year-over-year change in the index by month. And I've got a long history here just to put into perspective so we know where we have been. And you can see back in June of 2022, inflation hit the highest rate that we'd seen in over 40 years in the U.S. economy. This was in the post-COVID period when prices were rising dramatically across the economy. But the Fed started raising interest rates, and they have had a very successful run at bringing down that inflation rate towards the Fed target, which is 2%. That's where they want to get inflation back to. But over the last couple of months, inflation is starting to tick the other way. And we actually just got in August's number today for inflation, and it ticked up to 2.9%, up from the 2.7% that we had in July. And the worst part of it is core inflation, which strips out food and energy, which are more volatile, was actually even higher. It was up to 3.1%. So the bad news is it does, the early indications in the data that came out today is that we're starting to see some of the commodities prices, stuff that people buy prices are starting to rise, and housing prices took a big jump in the last report. So inflation is starting to heat up out there, and that was one of the things that many people were concerned about in the wake of these tariffs. The positive from all of this, though, is it does mean that it looks like the Fed is going to be in a position to be lowering interest rates. And that's why we're seeing the stock market rise. But we'll talk about that in just a minute. The other mission of the Fed is to keep unemployment at full employment as much as possible and keep unemployment low. But we're starting to see that the unemployment rate is actually rising again. Again, we've got a chart here that's showing about 70 years worth of data. And you can see historically where we are today, we're still looking at very, very low unemployment rates, well below the 6% sort of year 2000 and beyond average that we've been running in the U.S. economy, the average. But it has been ticking up over the last few months. And in August, it rose to 4.3%, the highest level we've had since the fall of 2021. And the numbers that we got out even just today is weekly initial unemployment claims came in 12% higher than where expectations were at. And that was the highest it's been in 4 years for weekly initial claims. So the environment out there is suggesting that the employment market is starting to fall dramatically. And in fact, the New York Fed released a data point from one of the studies that they do from people asking them, what is your confidence in finding a job? And in August, the respondents said that their confidence in finding a job was the lowest since 2013. So we're starting to see the employment markets out there weaken quite a bit. And this was the concern that folks had, that this could be leading us towards a worsening economy. And when we look at job creation, the number of jobs that are created each month, historically we were in sort of the 150,000 jobs created each month. That's sort of what we need to keep unemployment stable in this country. If we produce more than that, we're sort of at full employment. We're going to see unemployment starting to tick down. If we get below that level, we start to see unemployment tick up. And you can see here that job creation, the most recent data points have been very, very weak. And in fact, we just had a revision this past week from the Bureau of Labor Statistics that they took away nearly a million jobs that they had previously recorded over the previous year, over the previous 12 months. So the employment markets are even weaker than what we had thought before. And in their revision, they actually took the employment number for June into negative territory. And that's what I've circled there over in red. That's where we are today. You can see how quickly, and looking at the 3-month moving average, that dotted line, you can see how quickly the job creation in this economy has been slowing. And so there's a lot of concern that these are the early signs that folks have been worried about, that we may be slipping into a recession. So that's a lot of the concern out there. The positive sign from all of this, though, of course, is that investors are expecting that this means that the Fed is actually going to cut interest rates. We can see that the equity markets, the Dow Jones is at an all-time record high today. And as I think the S&P 500 as well, or maybe it's just off a little bit. But clearly the investors are responding positively to this negative employment news, because it does suggest that the Fed is going to take action and start lowering interest rates again. And they've got a meeting next Wednesday to talk about this. And at this point, it looks like about a 25 basis point cut is expected, is almost a certainty. But there is hope that it could be as high as a 50% basis cut. And I think the more bad news that we're getting here over the next couple of days regarding the job situation, I think is fueling that speculation on Wall Street that there may be a bigger cut than even what folks were expecting. So that means this purple line here, that's the federal funds rate. They haven't had a cut in quite some time. But it is expected, as I said, that they're going to cut again next week. And that is going to be positive for both new and used auto loans, which you can see in the green and red, both remain quite elevated. So that decline in the federal funds rate should be positive in bringing down lending rates, which will help automotive here through the remainder of the year. But again, with the employment situation weakening out there, it may not be enough to sort of offset weakening in the overall vehicle market. The other thing folks are concerned about, and I've showed you guys this slide many times before, is the overall consumer sentiment in the U.S. economy. And this is a chart from the University of Michigan that looks at, they talk to thousands of consumers each month and ask them, what is your overall outlook on the U.S. economy? And you can see from where we are today, it still remains very, very low. It has increased a little bit from where we were in June of 2022, but it still remains well below sort of the long-term average in the sort of 80 to 90 range. But I think it's interesting to note that, in June of 2022, just a couple of years ago, consumers in this economy thought this was the worst environment that they'd ever seen. And it's as far back as this metric gets measured, which is into the 1970s. We had the double dip recession, the S&L crisis, the 9/11 attacks, the Great Recession, all terrible periods for the U.S. economy. But according to this survey, consumers felt that June of 2022 was even worse than that. It was an all-time low. And that's when that gasoline hit $5 a gallon across the country. The inflation rate hit those 40-year highs I showed you on a slide a couple of slides ago. But we've been improving since then. But over the last few months, and really in the wake of Trump coming in and declaring the tariffs that he wanted to implement, we've seen that the consumer confidence has just fallen dramatically. And these are recessionary levels. We need confident consumers out there, because only confident consumers, people who feel comfortable that their employment situation is stable, that the economy is stable, it's those folks that are willing to borrow, $20, $30, $40, $50,000 to buy a new or used vehicle. Folks that are not confident about the outlook are likely to pull back from the marketplace. But of course, and I've showed you this before as well, that sentiment is not universally shared. There's a steep divide in this country as to where we are economically on the outlook right now. And if you split it out by Republican, Independents, and Democrats, you can see that the country remains very, very divided. On the far right, you can see where we are today, where the red line, Republicans, are still quite optimistic. They're actually, near highs that we haven't seen in since October of 2020, just before Biden was elected. They're quite pleased with the situation that we're in today, but it's polar opposite to where we can see Democrats are, that blue line. And what's interesting here is that at this point, it looks like independents are leaning more negative, and this is why it's bringing down the overall number of sentiment in this country. The reason why this is important is this may reflect who is actually in the market buying today. If you're someone who's very, very concerned about the outlook for the U.S. economy, you're probably less likely to be out there buying a vehicle. So clearly, people's perceptions of where the economy is and whether the glass is full or half empty varies greatly, and that is likely to impact the marketplace. But we also do a survey here at Cox Automotive where we talk to car dealers and we ask them what is their outlook on where the economy is right now. And that's our dealer sentiment index. And we just got the third quarter results a couple weeks back. And I thought I'd share them with you today. Really not any sort of earth-shattering movement out there, but we are seeing sort of a general reflection that things are a little bit less favorable out there in the vehicle market. We asked car dealers out there, how would you describe the current market for vehicles in the area you operate? And we can see that overall it ticked up just a little bit at 43, but we can see that franchise dealers are actually had a downtick, a little bit more pessimistic on what their feeling is in terms of the overall vehicle market today, while independent dealers actually had a little bit of an uptick. But we also asked, what is your view as to where the market's going to be 3 months from now? And again, we can see that franchise dealers are ticking down. They see the market getting a little bit more difficult, but they still remain optimistic. They're above that 50 level threshold, which is sort of the break even of optimistic, pessimistic, but it is starting to deteriorate a little bit. And overall, you can see that dealers in general remain on the pessimistic side, since they are below 50 in this measure. So there's not a lot to write home about in terms of enthusiasm on where the vehicle market is headed. We are also seeing that we asked them, how would you describe your current inventory levels? And that's the dark blue number. And you can see that that's actually ticked higher. Dealers feel comfortable with the amount of inventory that they've got right now. They feel that we're not in any sort of a dire inventory situation. But we also asked them, how would you describe your profits over the last 3 months? And you can see that that's actually ticked down a little bit, that light blue line. So generally, if you remember a couple of years ago, we had that seller's market where there was very, very lean inventory and profits were incredibly high for the car dealers and manufacturers. We're not in that situation today, but certainly that's one that is to keep an eye on, that if we see the inventory situation tighten dramatically, we should also see that profitability should improve as well. So the other thing I just wanted to mention is we asked, what are the factors that are holding back your business today? And we did see some interesting changes overall in terms of what dealers were saying out there. Overall, the number one issue that's holding back is the economy, but it actually moved down a little bit in a more favorable direction. So the view is that the economy isn't quite as detrimental to the overall vehicle market as dealers had thought before. And we're seeing a little bit of cooling on the concerns over the political climate. I think there was a lot of concern, that when President Trump came into office, there was going to be all kinds of turmoil. A lot of that didn't come to be. And so I think a lot of that uncertainty has moved away. And there was concern about the tariffs. That's the other big mover that we saw, and the implications it would have for vehicle parts. Frankly, the president has backed away so much from many of the initial tariffs that he set that I think a lot of those costs just have not been incurred yet. And we're going to talk a little bit more about that. But overall, dealers feel that these tariffs have not been as detrimental to their sales as I think many of us had previously thought. So overall, our vehicle market outlook still remains fairly optimistic. We don't see any kind of major decline in the market just yet, but we are very concerned that the buying circumstances are starting to change out there. And I think we've all been very surprised the fact that the manufacturers have not been passing along these price increases. Looking at the vehicle sales, the monthly vehicle sales SAR, we just finished the month of August at a 16.0 million rate. That was down from a very strong number we had in July of 16.4 million. And the very, very high rates that we had in the initial days after the president first announced these tariffs back in March and April, we had 17 million plus SARs here in the vehicle market, as a lot of folks rushed out to buy before tariffs might have gone up overnight. But overall, our forecast, we've had to give quite a bit of range here. We were a little bit lower, sort of in the 15.6 to 15.7 range. We've moved a little bit higher now because these tariff impacts really have been delayed. We're just not seeing the price implications that we were expecting to have happen as quickly as we thought they would. So we're a little bit more optimistic. We figure this year is going to finish closer to about a 16.0 million. It's next year that we start to think that maybe these tariffs are really going to start to take a bite out of vehicle sales, because these higher prices are something that manufacturers are just going to have to pass along. Thus far, we can tell from their quarterly earnings back when they were announced a few weeks back from the second quarter, they're eating these tariffs. We saw, billion-dollar plus statements of amount of money that's being paid to tariffs. But we do think that at some point the manufacturers are going to have to change that strategy. And I think a lot of it is they just haven't been able to respond. The tariffs have been a moving target. They don't want to be a first mover in terms of raising prices on their products and being uncompetitive with some of their competitors. And I don't think manufacturers want to raise prices and be a nail that's sticking out for President Trump to try to hammer back down if he didn't like some of the price increases. So I just think a lot of the uncertainty around tariffs has made it very difficult for the manufacturers to respond. But I do think that that's likely to change here in coming months. So tariffs, well, who cares? So far, yours truly thought that we were going to start to see a lot of negative implications from this in the vehicle market, but vehicle buyers just have not responded that way. This is a chart that's looking at our vAuto data, and you can see on the left, this is the weekly run rate that we're seeing on new vehicle retail sales. And in 2025, that's in red. You can see the big jump that we had back in March and April when President Trump first announced these tariffs. We had a big surge in the market. We then pulled back down. But then over the summer in July and August and since, we're seeing the vehicle market pick up steam quite a bit. And we're also seeing this in the used market as well. Normally this time of year, the used market's kind of quiet and is sort of shifting down gears. The fourth quarter is not normally known to be a very strong period for the used vehicle market, but we're heading into it with very, very strong buying rates right now. And I think what we're seeing is a couple of things. One, trade-ins from the new vehicle market is probably helping new used vehicle sales, because we know the used vehicle market is very lean right now. So the rush of activity that we're seeing on the new side is probably helping the used side. And what is helping the new vehicle side? Well, I think there's a couple of things, but certainly the president changing the policy on the battery electric credits, the $7,500. They passed a big, beautiful bill at the end of June. I guess it was right before July 4th weekend. And that eliminates that $7,500 tax credit. And that's going to happen on September 30th. And since that point in time, we're just seeing a mad dash out there for folks to want to buy or lease an electric vehicle to take advantage of those tax credits. So it's really those things that are really seeing the vehicle market take off. And I think they're both surprising. We weren't expecting that. But the other thing is that the initial tariffs that were announced back in earlier this summer, we've settled at rates much lower than what we had thought before. And the president, when he first announced these things at the end of March and beginning of April, was talking about 25, 30, 45, 50% plus tariff rates on any imports. But he has settled at much lower levels with many of our trading partners. The UK, we're down to a 10% rate. From Japan, Korea, we're looking at a 15% rate. Where there's still a lot of uncertainty is around Canada and Mexico. And I think there's a lot of posturing that's going in there as we get ready for USMCA renegotiations, which were scheduled to happen next year in 2026. But clearly some sort of agreement has to be worked out, because as it stands now, imports from Canada and Mexico are looking at the highest tariff rates of all, at least among our major trading partners. There are some offsets that for parts that were made in the U.S. That were USMCA compliant, but that all is phased out after a couple of years, at least in the initial tariff announcement. So there's still a tremendous amount of uncertainty around these tariffs. But there are real costs that are being incurred. And since March 30th, we've had steel and aluminum tariffs. They've gone up to about a 50% rate. This, we estimate, is somewhere in the neighborhood of about an $800 cost per vehicle just on the steel and aluminum in those things. So that cost is something that has been incorporated into the manufacturer's processes. And they're either going to have to eat it or they're going to have to raise prices to get some of that back. And we think that that's going to start to happen. So we were expecting an initial sales surge. We got that. But we were also expecting some other things like declining incentives, auto suppliers under stress, border and custom challenges. A lot of these things that we really thought were going to happen didn't materialize. And I think a lot of it, again, was because there was so much uncertainty around these tariffs and they were delayed so many times. Nothing really got going here. But as we get more firmer into these trade policies, I think we're going to see some more long-term strategic planning decisions. And I think when we look at long-term planning, we're going to start to see the manufacturers really look at their product portfolios and decide we have to make some significant adjustments. We may see some products be completely eliminated because they're just not going to be profitable if they're going to be facing these types of tariffs from wherever they're made of. So those are all things that are still going to shake out here over the next couple of years. But I think the other thing that why we're not seeing much reaction to the vehicle market from these tariffs is that the vehicle market has changed dramatically. In the new vehicle market today, we have a much more affluent vehicle buyer. And this is a chart that shows buyer income and what the annual income and buyer and what percentage they were of the marketplace. And really the key takeaway you can see here is on the two ends. For the lower income folks that just made $0 to $50,000 each year, and that would include a lot of retirees who may have a lot of money in their 401ks, but aren't making a lot of income necessarily. But we can see their role in the vehicle market has fallen dramatically. And where is it gaining? Well, it's gaining on the most affluent. And in fact, if we just look at what's changed over the last 5 years, the share of the market that's over $150,000 has gone from 18% to 29%. And the share of the market that has income below $100,000 has gone from 50% to just 37%. So we have a much more affluent vehicle buyer out there today that's probably more insulated from a lot of the concerns about job losses and inflation and interest rates, because when you're making this kind of money, you just don't have to worry quite as much from a lot of the volatility that a lot of folks that are living on the margins have to worry about. And I just pointed out there, when we think about on top of income, there's just wealth in general. When we look at the S&P 500, it's up 19% from where it was a year ago. In fact, it might even be more today. I put that number out there from yesterday. And from April 8th, which was sort of in the immediate post-Trump announcement doldrums of where everything was sort of the worst, at least from the financial markets perspective, we're up 30% on the S&P 500. And if you're into Bitcoin, well, that's up 96% from where it was a year ago, or nearly 50% on April 8th. So there is this wealth effect that this wealthy vehicle buyer, we got more of them, and they've had a really good last few months. And so that's, I think, also contributing to the health that we're seeing in vehicle sales right now. So let's talk about the vehicle market and some of the impacts that we are seeing. And there are some interesting trends that are emerging here in 2025. Let's start by talking about brand market share. And this is a chart that's showing annual market share from 2019 to what we're seeing so far year to date this year of the top 12 brands. And they represent about 80% of the total market. And that orange is showing the 2025 market share. And you can see there's some interesting jumps there. Toyota, Ford, Chevrolet, all looking at very large gains in market share this year, while we're seeing other brands like Subaru, Tesla, Jeep, they're losing market share. And I think one of the interesting takeaways, and I'm trying to understand this, is what is this actually reflecting? I do think that we're maybe seeing that those brands with the largest portfolios, with products across entry level, subcompact SUVs, all the way up to larger pickup trucks, having a full portfolio, seem to be gaining the most market share right now, while those brands that are very specialized and cater to just very bits and pieces of product segments are suffering. They may not have quite the product versatility to meet consumer demands right now. So I think that's one of the interesting things that we're seeing out there. The other interesting thing is what we're seeing in terms of segment share. And this is a chart that's looking at the top 10 vehicle segments, which represent about 87% of the total vehicle market. And one of the trends that we're seeing here in 2025 is actually a holdover from 2024 and actually the last couple of years. And that is that the smaller sizes appear to still be doing well. And I look at compact SUV, subcompact SUV, compact car, the compact and subcompact, the smallest, most affordable products in the marketplace today, are looking at year after year after year, at least in the last few years, of gaining market share. And I think what that is reflecting is that consumers are looking for ways to mitigate these high monthly payments. And so they're having to shift to smaller vehicle sizes. And where are they shifting from? Well, they're shifting from the higher vehicle size. You do see mid-sized SUV actually is up a little bit this year, but you can see over the last few years it has been declining, while compact SUV and subcompact SUV has been gaining some of that market share. But we can look at full-size truck. That market share has been falling dramatically over the last 4 or 5 years. Mid-size truck having a big year. Again, people wanting to keep that functionality, but needing to get the smaller size so that they can keep that monthly payment in their realm of affordability. So this is a trend that's been going on, and it appears to be continuing this year as well. But right now, the situation we're looking at right now is that inventory out there for the new vehicle market remains very, very tight. On the left here is showing available supply. This is the total sum of what is on dealer lots all across the country. And you can see that right now we're about 6% below where we were at this point last year. And in terms of days of supply, how long will that inventory last based on the current sales trends? Well, we're currently at about 77 days, or about 13% lower from where we were last year. So on a relative basis, the inventory situation is fairly tight here going into the fall. And we're in a period now where we're starting to get many, many more of the new model year vehicles coming in to inventory. And those new model years are all going to have, well, not all, but I'm sure the vast majority are going to have a higher price point. So we're going to have this natural sort of inflation in the vehicle market that's coming as this new inventory starts to take hold here out there in the marketplace. So nationally, we're at 77 days of supply. But when we look at it by the different brands, you can see that we're in a very, very varied situation out there. On the far left, we've got Toyota and Honda, and they're looking at days of supply, well below the national average. For Toyota, they're less than half of the national average. Versus at the other end, you can see Ford, Jeep, Ram are still looking at days of supply at a very, very high level. So we would expect that the response in the marketplace is going to be quite different. Those with tight inventories are probably going to be pulling back on incentives, or at least don't need to be as aggressive on incentives in order to move that metal, while we would expect folks on the far right there with a lot of inventory available to be a little bit more generous with the purse strings and be offering more incentives. And so that's going to be the battle that we're looking at here for the remainder of the year. What is going to be the incentive strategy as manufacturers are trying to deal with these higher prices that are going to be coming from these tariffs? So overall, this is a chart that's looking at new vehicle incentives as a percent of the transaction price. So how much money was taken off of the vehicle relative to its overall price that it's sold for. And you can see the most recent data point we have for this from August is 7.1%. Our expectation is that at this point we would see this number be trending down even more. Our expectation was that the manufacturers were going to have lean inventory. They wanted to have lean inventory, but they were going to pull back on incentives in order to kind of offset some of the losses that they are facing from these incoming tariffs. But that just hasn't happened yet. They've come down a little bit on incentives, but they still remain relatively high. And certainly incentives are well above the levels they were at during the seller's market that we had back in 2022, where essentially there was no discounting to be done. Manufacturers didn't need to offer incentives because the inventory was so tight. We still expect that we're going to see the manufacturers have to get a little bit more aggressive, pull back a little bit more on incentives here as they let the inventory situation tighten. The question is going to be is if that demand side from consumers can hold up. If we don't see a recession, if we don't see job losses, I would expect that vehicle demand can still remain quite strong, allowing the manufacturers to pull back on these incentives. But if we do see the job losses start to rise and we start to see that there's real concern out there in the stock markets and we see stock markets sell off, then I think that we're going to see that even these wealthier buyers out there are going to pull back on their vehicle buying, and then the incentives may not be able to come down because the manufacturers are going to need to be discounting in order to make those sales. But we're still dealing with high prices out there, and we're starting to see that the trend is heading higher. On the left here, this is showing the average monthly vehicle transaction price from our Kelley Blue Book data. The most recent data point was $49,077. This was about 2.6% higher than where it was last year. And that's what that chart is on the right there. That's showing the annual change in prices. And what I wanted to try and do with this chart is show that if we didn't have COVID, if we sort of kept along the pricing trajectory that we were at before COVID, that's what that blue dotted line is there on the left, prices would be today more towards the $44,000 range. But you can see that red line, prices really jumped during that lean inventory period and took us to this $49,000 level that we are today. On the right is showing the annual change in that price. And we normally have about a 3% inflation rate in the new vehicle market. That's what we had historically in the decade prior to COVID. But during those lean inventory periods, you can see the annual change in prices rose dramatically to double digits before coming down. And it had been in negative territory for quite some time last year. But now we're back on the positive side, that new vehicle prices are now growing again. And with all of these concerns about tariffs and the higher prices that are coming, that's only going to put even more pressure on these transaction prices. So we do see that the inflation is starting to heat up again in the new vehicle market. And when we look at the used vehicle market, it's a similar story as well. This is looking at used vehicle retail sales on the left, and the most recent average transaction price we had there is $25,393, well above sort of the $20,000 level that we had in pre-COVID period. But the interesting thing here is what's happening on a year-over-year basis to prices, and that's what's the annual change on the right. And really, after we had that lean inventory period of 2021, 22, and 2023, used prices came down dramatically and were actually decreasing. We had deflation in the used vehicle market for much of last year. But as you can see, over the last few months, price growth has started to turn positive again. And the most recent data point you can see is that we're looking at used prices back above zero. And so we're again expecting that this is sort of adding this inflationary environment to used vehicle prices. And we have a vehicle market in the used side that is very, very tight right now. Days of supply is around 43 days, which is spring of 2023 levels right now at car dealers. So they're not in a situation where they've got a glut of inventory out there and are going to have to start cutting tremendous deals. And all of that's creating this inflationary environment for used vehicle prices. And when we look at the movie, the Manheim Used Vehicle Value Index, we just had our numbers announced last week for what we had seen at auction or at wholesale values, and they were up nearly 2% on a year-over-year basis. But we are seeing some differences by product segment. And really the interesting one here is, sedans were negative, but SUVs were actually up. But where we saw the largest gains on a year-over-year basis was used electric vehicle prices. They were up 4.6% in August. And a lot of that move is due to the fact that the president has pulled back on that $7,500 tax credit on the new vehicle side. And that's going to mean that a lot of the erosion of vehicle values that these discounts had is now going to be gone. And I think that's going to make the whole used electric vehicle market see those valuations actually rise a little bit because there's just not as much discounting happening on the new vehicle side. So what's next? Well, let's talk about the EV and the plug-in hybrid Armageddon, which is just weeks away. And I may be a little hyperbolic to talk about it that way, but we're just going to see a massive change in the market almost overnight here when we get to the end of September. But let's look at why this is going to be so important for the vehicle market. And this is a chart that's looking at the year-over-year change in sales. And this is actually registrations data, but I'm using it as a sales proxy. And looking at the different channels, we have retail purchasing, we have retail leasing, and then we have fleet activity. And overall, the year to date, the market was up about 5%, but it's actual retail purchasing that's up the most at up 7%. And are we seeing the greatest retail purchasing? Well, you can see that traditional hybrids are up 41%, but battery electrics are down 24%. It is not the sale or the purchase of battery electrics that's really moving the needle this year. What we're seeing, however, on the retail leasing side is quite a different story. Overall, retail leasing is only up about 1% on a year-over-year basis, but electric vehicle leasing is up 49%. A huge movement there, and as well as traditional hybrids up 45%. So we're seeing a big shift of leasing, battery electric leasing, and the other thing we're seeing, interestingly, is plug-in hybrid is kind of falling from the wayside on fleet. The commercial applications of these battery electrics and plug-ins is becoming less favorable in the fleet market. But the reason why this is going to be so detrimental is that the role of EV leasing in the market and plug-in hybrid leasing is massive. And you can see 60% right now, leasing share of all retail is about 24% for the whole market. But leasing share of retail for battery electrics is 61% and is 60% for plug-in hybrids. The prices of those two categories is going to change dramatically come September 30th, because many manufacturers have been leveraging that $7,500 tax credit in order to offer a very substantially discounted electric vehicle or plug-in hybrid lease. And the vehicle market has been gobbling this up since this was introduced back in the Inflation Reduction Act back in the fall of 2022. Back in the fall of 2022, we had the Inflation Reduction Act, which allowed manufacturers to use a $7,500 tax credit to discount the purchase of a vehicle, but there was all kinds of income requirements around that, so it made it difficult to implement. But they also allowed it to be applied for a lease for a commercial vehicle. So leasing is considered a commercial sale, so they were able to offer a $7,500 cost reduction on a lease, and that's why we've seen these tremendous couple of $100 lease offers all around the country over the last few years. Well, consumers have been gobbling them up, and you can see those purple and green lines. Plug-in hybrid and battery electric leasing share of retail has just exploded, while across the rest of the market in ICE and traditional hybrids, leasing really hasn't moved at all. This is going to change dramatically. As soon as that $7,500 tax credit expires, we're going to see a lot of folks just pull back from buying electric vehicles or leasing electric vehicles significantly. They were attracted to that low cost point, as well as sort of the advantages to leasing with this new changing technology. certainly a lot of folks didn't want to make the commitment of purchasing these electric vehicles. And so our expectation is we're seeing a lot of folks that were even thinking about buying an electric vehicle. Well, they've come to market now. They're buying in July and in August. We had July and August had two of I think the three strongest electric vehicle sales in history. We're expecting September is also going to see very, very strong electric vehicle numbers. But then after that, there's, dealer lots are going to be basically cleared out. There's not going to be a lot of product left. And there's not going to be a lot of consumers left that are interested in getting into one of these things, because anybody who's interested is probably in the market today already pulling that trigger. So the impact of all of this is going to be substantial. We're expecting the fourth quarter sell rate to drop dramatically for the new vehicle market. We're going to lose a couple of 100,000 sales off of our normal run rate, because a lot of folks are just not going to be able to buy. The prices are going to be too high for them, or their interest in electric vehicles just has dried up. You can see for the impact for different brands, it's going to be quite varied. This is a chart that's showing brands' sales by portfolio, what percentage of their sales come from the different powertrain types. And you can see on the far right, like Buick and Ram, these are brands that are 100% ICE vehicles, or at least they have been thus far. So the changes of what's going on with plug-in hybrids and battery electrics isn't going to really affect them. But on the far right, you can see, in solid green, Tesla and Rivian, they're 100% battery electric companies. Clearly, this $7,500 cost increase is going to hit their products and their customer base significantly. And then in between that, you can see the impact on different manufacturers is going to be quite varied. Nationally, it's about 11% of the market so far year to date. 11% of retail activity has been battery electric and plug-in hybrid sales. So 11% of the market is looking at a massive price increase in just a couple of weeks. What the ramifications from that are going to be, it's hard to know. But again, we expect that there's going to just be a lot of pullback on some sales activity out there. And when we look at the impact, geographically, it's quite varied out there for different states as well. Again, nationally, we're at 11%, but you can see on the far right, you got Oregon, Washington, D.C., Colorado, California. Huge portions of their vehicle market, up to 20%, are these battery electric and plug-in hybrids. So 20% of their market is looking at a $7,500 price increase in just a couple of weeks. It's going to have huge ramifications for the vehicle market here in the fourth quarter. So again, the ramifications across the country are going to be quite varied, because there are parts of the country they're just dabbling in these alternatives. They don't really do a lot of sales of those things, so they won't be as impacted. But it's going to have implications, I think, for everybody, and certainly for car dealers that are spread across the whole country. But if there's any positive about this, is that we do have a lot of electric vehicle markets that are electric vehicles that are going to be coming back to the used market in coming years. We've been leasing so many of these battery electrics and plug-ins since the Inflation Reduction Act in 2022. Well, we're now getting into sort of the 3 years post that period. So we're going to see many, many more of these vehicles coming off lease over the next couple of years. And you can see, actually, our own forecast is by 2027, we're going to have about 500,000 battery electric vehicles coming off lease, and are going to be available for consumers to buy out there. And so that I think it's just something to know that these are coming, and their valuations are likely to probably strengthen a little bit, because we've seen such pullback on the discounting side of electric vehicles. It would make sense that on the used vehicle side, existing electric vehicles are likely to see their price valuations rise a little bit, since we're cutting back on all the discounting that we've been doing on the new side. So just been making sure that dealers are aware that this is coming and to be prepared for it. The amount of interest that consumers are going to have for these vehicles, we just don't know yet. But certainly they're going to be a much more affordable option to many of the new prices that we're seeing today for battery electrics. So just to kind of wrap it up for the year, we still remain optimistic that new sales are going to come in around 16 million for the year. It's really next year that we think that we're going to maybe see sales have to take a break a little bit as all the dust settles from these tariffs, as well as the change in the battery electric discounting. But overall, we still see that the market, there's really no massive decline or huge hit that we're expecting to see just yet. But the buying conditions are starting to worsen for consumers out there. And the underlying economic conditions are something to be keeping aware of, because it does look like the economy is starting to slow. And I think a lot of forecasters are expecting that we get to the fourth quarter, we're really going to start to see some of the key data points like inflation, like unemployment, really start to reflect changing conditions out there. So I wish I had better news for you. I think for the vehicle market, as I said, we still got consumers out there that want these vehicles, and a more wealthier customer base that can afford these vehicles. And I think as long as the stock market continues to hold up in the face of all of this uncertainty, I think the new vehicle market will hold up fairly well as well. So those are my comments today. I urge all of you to visit Cox Automotive. We've got a website, Cox Automotive Newsroom, where we post all kinds of information and articles every day about what's going on in the automotive industry and what our views are on it, from Jonathan Smoke, our chief economist, as well as our other analysts on our team. I urge you to come visit there and take a look about what we're saying about the latest important information that you should know about. And so those are my comments today, and I think my presentation will be distributed later, and I urge you to drop me a note if you have any questions or concerns. I'd be happy to talk to you.
Charlie, thanks for joining us today. Your quarterly updates are tremendously relevant in this ever-changing environment, and we just really appreciate you. So thanks. Again, like Charlie said, you'll all be receiving a copy of this presentation and recording by early next week. To those on the line, join us back here on Tuesday, September 16th at 2 p.m. Eastern as CNA National talks F&I strategies to drive sales and deliver results. To learn more about AIADA, visit aiada.org. Thanks for joining us, and have a great day, everyone.